Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, February 27th. Nvidia reported another quarter of higher than expected results as Blackwell chips brought in more than 10 billion US dollars last quarter, and their forecast also beat analyst estimates. But the costlier manufacturing of these next generation Blackwell chips actually kept the increasingly harder to satisfy, the increasingly harder to impress Nvidia investors on the edge yesterday. After the bell, the stock price fell 1.5% in the after hours trading. Well, Nvidia continues to do an amazing job, to say the least, in the first place, and actually defies those expecting the company to make a mistake because it has been repeatedly and constantly beating both earnings and revenue expectations and the forecast as well since the beginning of 2023. The beginning of the AI buzz. So it did the same thing when it reported its earnings yesterday after the closing bell. The revenue at Nvidia grew 78% compared to a year earlier and came in at 39.3 billion US dollars. It's higher than the 38.5 billion US dollars penciled in by analysts. Net income hit 22.1 billion US dollars, an 80% surge from a year ago, also beating analyst expectations, which were just below 20 billion US dollars, and the revenue from the data center was up by 93%. And the revenue from the Blackwell chips, that were launched last quarter, the new generation chips, was also an eye-popping 11 billion US dollars. That was also higher than the expectation of about 10 billion US dollar of revenue from the sale of these new chips. The company also gave a higher than expected revenue forecast for the current quarter of around 43 billion US dollar of sales. So if we put in perspective all of these numbers, the Nvidia's revenue was just about 6 billion US dollars when the AI buzz started at the start of 2023. But there's a catch. Of course, manufacturing of these Blackwell chips proved to be complex and costlier, and the company warned that it could squeeze the profit margins more than anticipated earlier. But do not get anxious when I say squeeze profit margins. I mean, the company's gross profit margin is around 73.5% today. So it's still very, very comfortable. And the cherry on top of it, the CEO, Jensen Huang, repeated that the demand for these new generation Blackwell chips remains amazing. He didn't say insane, but amazing. And the Stargate project from Trump administration will also keep the AI spending robust. And in all cases, Nvidia's biggest clients have pledged to continue to spend big on AI this year. And note that about 90% of Nvidia's profits came from the data center segment last quarter. And that's basically the business that comes from large cloud service providers and other technology firms. And to put things in another perspective, Nvidia's data center division makes more revenue by itself than Intel and AMD combined. So Nvidia's got its back covered for now, at least in the short run. So the numbers were good. The forecast sounded good as well. There is no doubt whatsoever that this business is still rolling on silk and that the company Nvidia will continue to thrive. But if you look at the market reaction to the latest earnings, you would hardly guess that the company reported such strong results last quarter. Because Nvidia's stock price fluctuated in the after hours trading after the earnings release and ended up by printing a 1.5% decline in the after hours trading. Warning that, one, investors simply got too used to impressive results. They are getting harder to impress, and the revenue beat is also getting smaller, of course. And the fact that the company didn't hit that 40 billion US dollar psychological mark certainly played a role. Two, the valuation of the company is quite high today. Nvidia's PE ratio is about 50. It is not insanely high though compared to other technology companies, but it is considered to be high enough. And Finamize analysts rise this morning that the company should print a 30% growth every year for the next decade to justify its actual valuation. Now, I believe that 30% growth is not impossible, especially over the next half a decade. And of course, the rise in competition, the risk that these big technology clients of NVIDIA will launch their own chips and that would reduce demand for NVIDIA's chips. Then the tariff talks, the tariff threats, and the risk that we may have overestimated the AI demand altogether. Remember the Microsoft views earlier this week? Well, will continue to hang in the air. But it's just about how much weight investors will give to these risks. I still believe that NVIDIA is expensive, sure, but it's not overly expensive compared to the others at the current prices. And the dips could eventually still serve as interesting buying opportunities for long-term investors who wouldn't be bothered by a short-term pullback in prices, which is actually not impossible at this point in time, despite the best results ever, because the market conditions, the overall market conditions are not necessarily ideal right now. So, zooming out, NVIDIA may not boost the market sentiment today in the same way that it boosted the market sentiment over the past 2 years after releasing its results, but the AI's mascot's earnings will sure not harm the AI outlook or be an additional drag. So the S&P 500 and Nasdaq futures are up this morning at the time I'm talking here. Let's see if that optimism could survive to the tariff talk, where there is some confusion out there in the market regarding when Donald Trump's 25% tariffs on Mexico and Canada would go live. Normally, they were supposed to be due for next week, remember, but there is now a chatter around that they could be postponed to the beginning of April. Of course, the tariff threats are weighing on global investor sentiment, but is also weighing on US own growth expectations as well. Now, the US growth update is due today and is expected to show a slowdown from 3.1% to 2.3% in the fourth quarter of last year. If that's the case, well, you would think, or you could argue, that the dovish Fed expectations could get a boost. But the tariffs actually complicate the Fed outlook, the Fed picture, because they boost inflation expectations at a time when inflation is already giving signs of heating up, and that could eventually limit the Fed's ability to step in and assist with lower rates. As such, the US dollar index has been trending lower on Trump fatigue, but the index has rebounded at yesterday's trading session from near an important Fibonacci support level, which is the 106 level. That is the major 38.2% Fibonacci retracement on September to January Trump-boosted rebound. The euro dollar is down for a second trading session this morning. The failure to clear the 105 psychological level sustainably could eventually weigh on sentiment here, but there is some optimism on the other hand in Europe that the US could eventually agree with Ukraine on a deal where Ukraine would, simply share its minerals with the US to end its war with Russia. So that would obviously be very good news for Europe, and even better news for Europe if the war ends with Europeans getting their own share of the pie. So that's certainly what actually boosted sentiment in European stock markets yesterday. The DAX, for example, rallied 1.71% on Wednesday on that very hope that the Ukrainian war could soon end, and that would release pressure on energy prices in Germany and in Europe altogether and help the nation Germany go back to growth after years of economic slowdown. And if the European Central Bank continues to give its support with lower interest rates to the European countries, that would be even better, obviously. But the ECB's own ability to cut the interest rates also depends on inflation outlook. So we will be watching Spain release its preliminary CPI update for February today, and France, Italy, and Germany update their own CPI numbers tomorrow. If these inflation numbers look soft, and ideally softer than expected, we could then see the euro remain under some pressure, but also we could see a sustained appetite for the European equities. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope This episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.